Folks, we are going to give you some great information here today, but through compliance, I got to remind you, every piece of financial advice is different for every single person. Seek individual financial advice.
There's a lie that all business owners tell themselves. I am not afraid. And that's how you have the courage to keep going and going and going. At Design Your Future Financial Services, we are business owners too. And that's why we are here to help those that help others. With our independent knowledge and financial experience, we help you grow, control, and keep what you work so hard to build instead of giving away to taxes, fees, loss, and the unknown. We understand that more powerful than fear itself is the will to succeed. So here's to our success. Reach out today to feel the joy that a financial plan based on your vision, your values, and your goals can make for you, your family, and your community. Let's design an even better future.
All right, folks, I hope everyone's doing all right. I know we just got hit by a huge storm. Fiona came and left a lot of destruction. As business owners, we're used to storms, and we're used to carrying weight on our shoulders. These presentations, the Millionaire Mindset on Mondays, are to help business owners like you really to make life easier. And today on the Millionaire Mindset, we're going to talk about the advantages and disadvantages of sole proprietor, partnerships, corporation, business structures. I know when I started my business, a lot of this stuff seemed very complicated. We're going to do the best to provide value. You're not going to get this advice from the banks, folks. We're going to try to provide value that you can actually use and hopefully share with other business owners. And that's our goal, is to really get the information and knowledge that actually works out there. And today we are very lucky to have experts, something my dad told me a long time ago, and I kind of forgot his advice, but his advice was hang around with smart people, especially when I was going to university. Great advice, Dad. And when I started off my business, I kind of started off hanging out with people that wanted to be successful, had that need. Took me a couple of years to figure out, no, it's time to surround yourself with those that are successful, those that are the creme of the creme. And that's what we have here today. We have Kevin Yuill, partner tax specialist at BDO Canada. And Jamie Angus will be sharing. Hopefully she'll be coming up here later. She is a phenomenal lawyer with Touchstone Legal that helps with corporate tax structures and mergers. Kevin, how you doing today?
Good, you?
Good. I'm going to
Yeah, there she is.
And Jamie's here too. Awesome. We got a great show here today. Listen, we're going to be asking all the tough questions here. And if you have questions, there's some people that have wrote in questions for me that we're going to ask these experts. Just because we're going to be so short on time, just put your chat in the chat, any questions you have, or save your questions for the end. It's going to be a great show. So instead of just showing a bunch of words and stuff, I'm going to stop the share here and we're going to get to see people's faces. So Kev, did I introduce you properly, or is there anything you'd like to add?
No, that was great. Thank you.
All right. How about you, Jamie? Anything you'd like to add on my introduction to you? What makes you so awesome?
I did not hear it just because I was on the wrong Zoom link. So I'll assume it was fantastic.
It was. All right. I can see some shaking heads here. Listen, I do have some great questions for you guys. I know when I was incorporating for the first time, I was a consultant in oil and gas. And I don't know if you know many engineers, but engineers, we tend to like to do everything ourselves because we think we can do it better than everyone else. I went through the whole process, tried to do my incorporated taxes. When I finally realized, okay, I need someone to do this, took my accountant and they said, what did you do here? And had to undo a lot of the things that I did, which ended up costing more money and the amount of time that I put in here. So what advice, I'll start off with you, Jamie. What advice would you give to someone why they would want to incorporate or why they would want to stay sole proprietor. I always like to start with the why before we start on the how and what.
Yeah, usually whenever anybody connects with me to talk about incorporation, I first talk to them about whether they need to be incorporated or not. And there's some people that don't. Usually, from my perspective, there's a few avenues. One is liability. And so when you operate a business as a sole proprietor, you are personally liable for anything that comes from that business. So if there's a claim by a creditor, a bank, a client, anything like that, that's a personal liability on you. And so we talk about getting commercial general liability insurance as sole proprietor and whether that covers off that risk enough to not warrant having an incorporated company. In a lot of instances, if there's any question about risk, so if they are running any business where they're providing a service to a client, so if they are building websites or if they're doing something online, building software, providing consulting, we always usually recommend that the commercial liability, it will not cover enough of that, and that's something that's personal liability. Now, if they have like a convenience store and they're worried about slip and falls, then that's a different aspect altogether that could be covered by commercial general liability. So we talk about what their risk potential is and whether a limited liability corp is the right way to go. I'd say 7 times out of 10, for liability purposes alone, I would recommend incorporation. And then usually we round it off with a discussion over the tax aspects, which Kevin can talk about.
Right on. So generally, 90% of the time, you would recommend someone to incorporate it just for the liability issues alone.
Yeah, right. Because when the corp is operating the business, then it's only what you have in the corp that's up for creditors to take from you. Your personal house isn't on the line, your personal investments aren't on the line. It's only what's in the corporation, and so that protects you that way.
And Kev, I know you have a lot of people that come to you deciding if they're going to incorporate or not. What are some of the rules of thumb you have for people to either stay sole proprietor or if they should incorporate?
Sure. So there's 5 big reasons why you would incorporate, and Jamie just hit on one of the major ones. The next ones are tax deferral is a big one. If your income is taxed as a sole proprietor, everything you make is taxed in that year. If you earn that income through a corporation, to the extent that you don't need all of that income and you can leave some in the corporation, there's a fairly significant tax deferral available. The corporate tax rate for most small businesses is around 11%, whereas taxes on personal income can be up to 54%. So the extent that you can leave those funds in the business, there's a significant tax deferral. There's also access to a capital gains exemption. I'm not sure if everyone's familiar with, but every taxpayer in Canada gets one exemption. It's currently around $912,000. You can sell shares of a certain type of corporations and receive a tax-free capital gain. If you're a sole proprietor and you sell your business, that tax-free sale is not available to you. So incorporating, if you have a saleable business, and quite often if you're a consultant, maybe your business isn't saleable, but most businesses are. So that's a big benefit of incorporation. A couple of the smaller ones, income splitting opportunities may be available as well, although the income splitting rules enacted in the 2018 budget have significantly curtailed that. There are still some opportunities. And there's also a corporation gives you an easier way to fundraise or bring in share capital. Let's just say you want to bring in, you need some funds, you didn't want to go, you couldn't get bank financing, or you didn't want bank financing. You could, get equity injections from people in exchange for shares of your business. So access to financing is another one as well. It's not really a tax driver, it's more of a business one, but it's certainly an advantage as well.
Awesome. So I know everyone's different and everyone's business is completely different, but do you have any certain rules of thumb financially, if people should incorporate or not, or is it?
Well, I find that the liability discussion often drives it. But let's just say we're in an industry where we've got adequate insurance and we're not concerned about liability. If you are spending everything you're making, don't incorporate, because the big benefits of the incorporation over the lifespan of a business is the tax deferral. But if you're spending it all, you're not saving any tax. And if you got to a point where you want to sell your business and get your capital gains exemption, a lot of people don't know this, but you can actually incorporate a business one day, roll your unincorporated business into a corporation, sell it the next day, and still get your capital gains exemption. So I just tell people, I say, yeah, I'm making 300 or 400 grand a year. I said, well, that's great. Are you saving any? Well, not really. I said, well, then I would save your money and don't incorporate for the tax reasons anyway. There might still be the business reasons like Jamie mentioned.
Right. So, maybe you're you have a job with the government, or you're a salary employee somewhere, but you have a side hustle, a construction side hustle where you're making 30,000. It still makes sense to incorporate for the side hustle for the reasons that we just talked about, liability and taxes, the main two ones.
Well, anytime I hear the word construction, Jamie would probably agree. I'd get that in a corporation for liability.
If you have a nice, healthy salary from the government and you're doing something on the side, that something on the side should definitely be incorporated, because you're probably pulling in some nice income that is going to be invested personally, and you don't want that to be endangered by your moonlighting activities.
That's right.
I've been doing this for over 6 years, so it would be considered a newbie by some, but I've really dove deep on a lot of things. And financial planning, folks, is simple until you get the government involved. And I'm not going to have a huge debate on blue, red, and orange here, but it just seems there's been more and more rules to make it more difficult to set up an incorporation properly or effectively, or to invest inside your incorporation. We'll talk about that soon. But Jamie, do you have any advice for those that want to set up an incorporation? They're going to have some extra money left over. So how would they want to set it up properly so they can invest inside their corporation as well without being penalized?
Yeah, so I guess if we're talking about actually setting up the incorporation, I would not recommend that they go online and just buy one, because that does look like a more affordable option, but we see those come through later and have to fix them. In the end, when you look at it, the grand scheme, fixing one that's been incorporated through an online portal costs just as much as if they'd just gone to a lawyer and had it done correctly from the start. And I've had some clients go back and get a refund on some money back guarantee for these online ones because they've messed it up so badly. So we definitely recommend, if you're going to incorporate, seeking out the correct advice from the start. And then from there, what the online incorporations don't help you with is they don't talk to you about the after administrative. So, setting up bank accounts and where you get those documents from and what insurance you should get. And we kind of had a checklist that people go through to try and make sure they've done everything necessary, whether it's a new incorporation or whether it's a rollover of business. And those are mostly for operating businesses. So in terms of investments, if you're looking at incorporating for investments, so you're deferring that income, that is a different structure altogether when you start to get into having excess cash build up in that operating company. And maybe Kevin would be better suited to speak to that.
One thing
disadvantages of that.
And I agree with Jamie completely. The cost of an incorporation is not that cost prohibitive that you should do it online, and I never recommend anyone do it online. But somewhere around the $1,500 range, and it's well worth it to have someone like Jamie set it up. As for saving in a corporation, it can be quite beneficial. And I'll give a very simple example. Let's just say you're earning money as a sole proprietor and you're making a very good living. And we all know the tax rates in Nova Scotia. And let's just say, for simple math, for every $100 you're earning, you're giving 50 cents to the government in tax. Well, that only leaves you, if you're trying to save, that only leaves you half of that dollar you've earned to invest. But if you invest inside your corporation and you earn that same $100, you only pay $11 tax. So you can turn around and give $89 to your broker instead of $50 to your broker. So there's a significant tax savings advantage to investing in a corporation as well. However, with every good thing, there's a bad thing. And if you have an operating business and you start saving, investing in that business, that creates complexities, which I'll call threefold. Number one, if you have too many cash or investable assets in your operating business, that business will no longer qualify for the capital gains exemption. So that tax-free sale is out the window. Also, nobody wants to buy that. Nobody wants to say, okay, I want your operating business. Oh, and you got $1 million of cash and investments in there. I'll pay for that too. Nobody wants to buy that. So you got to take it out. To take it out, you have to take it out as a dividend, pay 48% tax in Nova Scotia. So you'd only be left with $520,000, which is not a great result. In this case, we generally suggest a holding company be what we would use for the investing. So Once you earn your operating dollars, you pay your 11% corporate tax, you would funnel the other $89 over to the investment company, and you would invest with someone like Steve in that. So you're investing with a much higher after-tax dollar, and you're preserving your access to the capital gains exemption.
Very powerful stuff. So years ago, it would be pretty simple just to have an operating company and a holding company, and you'd switch it over. But that's not necessarily the case anymore. Can you dive into that a little more?
Yeah, back in 2015, Canada Revenue Agency lost a case, and so they rewrote some legislation. And what Jamie and I would generally say is it was like hitting a fly with a sledgehammer, and there's some unintended consequences. So you used to be able to just have these shares that could sit between your operating company and your holding company, and you could pay dividends across in those shares. Those are now taxable transactions. So generally what we see, and if you're talking to other business owner friends, most of them will have what's called a family trust or business trust that will own the shares of your companies. That will allow the tax-free flow of dividends between operating and holding company without any tax repercussions. Jamie sets up a lot of these. I mean, I have hundreds and hundreds and hundreds on my server at work, business owners that have trusts. Very, very, very flexible tax planning tool.
Yeah, definitely when we're talking to new incorporated businesses, we say, if you know for certain that you're going to be amassing a good chunk of cash in that company right off the bat, then we might as well do the structure properly from the start with 2 corps, an operating one and a holding one, and a trust to allow you to move the money between them. If you think it'll be like a 2 to 4 year window before there's going to be any excess cash in this business, then sometimes we tell you the cost of doing it now versus the cost of adding that in later, and you make the call.
Awesome.
Yeah, and those trusts actually have a 21-year life. So for a fairly young person with a successful business, I might say hold off, because like I said, they do expire after 21 years. So it sounds like an enormous amount of time, but I've been doing this long enough now and starting to feel old that some of these trusts I put in place years and years ago are starting to come due pretty soon. So timing's important too.
We just worked together on a fella who's been incorporated for a long time and working so hard, nose to the grind, like most business owners, but all of a sudden hidden out of the ballpark, just all of a sudden big money. So we had to set up the operating company properly. We set up the trust, and now we're setting up the holding company where we're going to transfer the funds. We're going to set up a properly structured dividend paying whole life policy. We're going to look at investing inside that holding company. But one of the questions that comes up a lot, do you ever recommend investing using your holding company or another operating company to invest in real estate? Why or why not? And I'll start with
Jamie, why don't you take that for the
yeah, I'll take that. So I have a speech that I do about what are called good assets and what are called risky assets. And good assets to me are cash in the bank. That is marketable securities, that's investments, that's secure, there's no liability coming back, there's no calls for capital coming back or anything like that. So those the only risk there is the market fluctuations and inflation. And then we have what I call risky assets, which are real property. When you invest in real property, although it seems like a sound investment on long term, there can be liabilities. There can be environmental liabilities, there could be tenants, there could be structural issues, there could be anything. So when we have an asset like an operating business or real property, we tend to say that should be in a separate entity altogether, another corp that keeps it sound so that you can loan money over and invest in the real property with those tax-deferred dollars, but we don't want all of your good assets, the marketable securities and everything, to be at risk if something were to happen with those real properties. And when people start getting into multiple real property investments, we start to then basket them to make sure that we don't have too many in one company, because you don't want all of your carton of eggs to break just because one broke. You want to keep them secure, and maybe you put only 4 eggs in this basket and 2 in this, and we assess it on a purchase basis as to whether it should go in what company. And so from my perspective, the $1,000 and your $1,500 for the incorporation and the annual fee for the tax return is far outweighs any risk that we'd have to bear by having that in your investment company. So we always say separate real estate go.
separate.
Yeah, I couldn't agree with that more. It might seem like a nuisance of all these companies, but like Jamie said, it's a small price to pay to protect your assets.
So a lot of business owners are making a lot of money inside the corporation, and we're going to talk about how to pay ourselves here shortly. But one of the problems that a lot of business owners come in when they do want to buy either a commercial property, not so much a commercial property, but maybe, you know, a vacation home or a second property or investment property, the banks say, listen, yeah, we can't help you out. Any advice on how to help those types of business owners out, those that have a lot of money in their corporation or making good money, but they're paying themselves a low salary, so it looks like they're not doing well when it comes to CRA and the bank's way of looking at things?
There's a mixture of pleasure and business there. So I don't know what you want to go, Kevin?
I would say that in my experience, the banks will generally look now at both your corporate earnings and your personal earnings. But I do find there's always a big nuisance when a person, you know, has been not taking a lot of money out of their business. They got a $40,000 dividend on their personal tax return. I do find that always creates headaches when you go to finance something. Even if you can say, look at all the money I got in my business, the bank still hassle you over it. Don't be
So
afraid
that-
to boost those earnings a bit.
Yeah. So that leads to one of the questions that comes up here. What is the best way to pay yourself from your incorporation?
Well, like anything else in tax, that's a very subjective, and everybody has their own different set of circumstances. I would make this comment though. If you are at the small business tax rate and you're incorporated, so you're under the $500,000, when you pay yourself salaries or dividends, when you flow them through to what eventually ends up in your genes, it's very, very close. And what I mean by that is salaries will reduce your corporate taxes, but you pay higher personal taxes. Dividends do not reduce your corporate taxes, but you pay lower personal taxes. And at the small business rate, I can do, you know, a flow through on that, and it comes out within, you know, a few hundred, maybe $1,000 difference. So there's not a whole lot of difference. But the salaries do generate CPP and RRSP room, whereas dividends do not. And there's a lot of mixed views on CPP and RRSPs. Some people like to have them, some people don't. So that's more of a personal preference rather than a tax driver, but there's really not a lot of tax difference.
Would you add anything to that, Jamie?
I guess, yeah. So one thing we did find during COVID is that if people didn't have salaries, they were not easily accessing all the COVID programs. So that was one reason. Also, if you have any government funding or anything like that, they like to see salaries. So generally having yourself on payroll from the start, even if it's just enough to get over the CPP amount, it is usually recommended, just from a good business perspective.
Okay, so what I'm hearing, a mixture is usually pretty good. Usually the minimum wage to get the CPP, and then maybe the rest in dividends, depending on people's circumstances.
That is often what people will do. And like Jamie made a really good point. When COVID-20 comes around, having some T4 income on your tax return is not a bad idea.
How about the business owners that are married to stay-at-home parents? Maybe the wife's working, making the big bucks. It is 2022. Dad's staying home, taking care of the kids. Is there any way that they can do income splitting?
Well, if you ask Mr. Trudeau, he'll say no. But as long as you can document that non-income earning spouse doing something, perhaps it's bookkeeping, some administrative functions, stuff like that, I certainly encourage people to put at least something on a T5 or a T4 slip to split the income. If the non-working spouse works 20 hours a week on a continuous basis during the year, you can split as much income as you want. But 20 hours a week might be hard, for a smaller consulting business, but for larger, operating businesses, that might be attainable.
I think that's a case-by-case basis, and it will depend on the comfort level of your accountant with that filing.
Yeah, and the taxpayer's risk tolerance level.
Yep.
Okay, we're coming to end here pretty quick, but just let's go back to the holding company, trust, and operating company. So explain the process now for people like myself, the financial planner. So in layman's terms, how that actually works and what you need to do to transfer money from your operating company to your holding company so you can invest it properly. Jamie, I'll let you start.
Yeah, so normally if we're moving it from an operating company to a holding investment company, the operating company technically is declaring dividends that are coming out of its retained earnings, and it's being allocated to the trust or paid up to the trust that owns the common shares, and the trust has an allocation to the investment company to pay the dividends over. And that process requires documents on both my side and on Kevin's side. So from my perspective, we do resolution of the company, resolution of the trust, and have directions that move it, or it actually physically moves through bank accounts. Bank accounts always being the preference to document the movement of cash, but we do paper trails if we have to. And then from Kevin's side, there's a whole filing obligations with all of that.
Yeah, so you need to file a T5 reporting the dividend paid from the operating company to the trust each year. And then the trust has to file its own special tax return. It's called a T3 trust information filing. And you need to file that so you can report the allocation from the trust to the investment holding company. And I just should note that those are all tax-free movements of cash. So there's no tax triggered in any of those transactions.
Yeah. What a lot of people find is that there's the holding company, operating company trust. It's more just an administrative burden that once you get used to, it's just, it's fine. But the first year at it kind of does seem a little bit overwhelming.
Like
Yeah, I
anything.
tell everybody the same thing. The first year, you're going to be pulling out your hair and you're going to be like, why'd I do this? But after the first year, you're good. You go
It's
through
like
one set of
having a
filings.
child.
Yeah, exactly. Jamie would know. She's got 5.
What are the main steps to set up well, I guess before I go to setting up the main steps to get the process started, is why then, if you have to go through all this hassle, why wouldn't you just invest in your operating company?
For the reasons I said earlier, so that creates a few problems, and it throws you offside for your capital gains exemption eligibility, Steve. And it creates a hassle that when someone comes to buy your business and you got $1 million in there, if you only have an operating company, the only thing you can do before sale is to take it out. You're going to be taxed at 48%. You're basically going to have half your money left because you didn't structure properly from the beginning. And that's one point I will make. Always structure earlier than you think you need to, because things happen. Tax planning takes time. And I have a lot of conversations with people that are like, man, my accountant talked to me about this 2 years ago and I didn't do it. And now you can't get a tax-free sale or some other complications.
That leads to the perfect segue.
I'll add one thing. So the other reason is because when we had the first initial chat about incorporation, it was about liability protection. And I said, what I want to protect you from is your personal investments and everything that's in your personal name. If you now have all your investments in your operating company, you have lost the whole purpose of liability protection, because you just put all your good, nice assets in with your operating company that has the risk. So yeah, we always say, don't put too much in there, or don't keep too much in there, because it is at risk, and the whole purpose of incorporating was initially limited liability.
Amen. Awesome. So that leads us to the next question. Perfect segue is, someone's thinking about incorporating, or they realized, oh man, I got to do this right. What are the steps that they take?
So when I meet with someone that has a proprietorship and they have a business structured that way, if it makes sense, I would call Jamie. And the process is, you have to do a legal purchase and sale agreement. You have to sell the business from yourself personally to yourself, the corporation. This does need to be documented legally. And there's an election that needs to be filed with Revenue Canada that will allow you to do that on a tax deferred basis. If you don't file this election, and you have a sole proprietor worth a good amount of money, that becomes a taxable transaction in the sale to your corporation. You just prepaid a whole lot of tax that you were hoping to pay down the road.
Yeah. And if you incorporate before you actually start running the business, you don't have to do that process, and that process adds to this. So a straight up incorporation is, say, $1,500 before you've started conducting a business. But once you're carrying on business and you have to go through the process that Kevin described, there's added costs on the legal and accounting side for those agreements and those elections. So
yeah, it'll cost you several $1,000s to do that.
Yeah. So if you know you're going to have a business and you think that it might do well, you're better off to just pay and incorporate from the start rather than wait.
All right. And usually that involves seeking professional help, either through your financial advisor, where, look, the majority of financial advisors are focused on investments and investments only, not that holistic approach. So your accountant and your lawyer will be able to help you out there as well. How's the best way to get a hold of you, Jamie?
Usually people just email me or give me a call. Yep. And then we start the process from there. It's a fairly straightforward process, as long as there's an accountant involved to deal with whether there is a rollover or not, which is that sale that Kevin talked about of an existing business to the corp.
Awesome. So that's Jamie Angus at Touchstone Legal. And Kevin, what's the best way to get a hold of you?
Same, phone or email, just Google Kevin Yuill at BDO and give me a ring.
You can see this is advice, folks, that you wouldn't get at the banks. This is there to actually help you. A powerhouse of information. People would charge big bucks just to listen to these two pros speak, and you're getting this for free for the time being. In conclusion, anything you'd like to say there, Kevin?
I would just say, I would reiterate what Jamie said. If you think your business is going to be successful, just incorporate now. Save yourself a lot of hassle and a lot of worry and a lot of cost.
That's great advice there. Jamie, any final words?
Yeah, I know for a lot of business owners, making the first sale or keeping sales up, but there's a lot of things going on. And don't let this fall off the radar. It's something that a lot of people put off, and it really can cost you more if you put it off. So think about it up front as one of the first parts of your business. And I know it hurts to pay the money up front, but it's worth it.
It's going to save you thousands in the long haul. Not even that long a haul, probably within a year or two. And listen, you provided me with a ton of value. I hope those watching got a ton of value from this. All we ask is you to share. We will get together every Monday at 11 o'clock and do the Millionaire Mindset and give you advice that you can actually use. So I hope everybody recovers well from the storm. And thank you so much for your time. I know time is our most valuable commodity. Really appreciate it, guys.
Thanks, everybody.
No problem. Thanks.
Talk to you soon.
Bye.